So gang, our topic for today is introducing the idea of the income tax. And so this is going to be our first lecture in a series of lectures. Notice that I've put prior to changes from the Trump administration. It would be very confusing for me to teach you what the new tax structure looks like. It will be far easier to look at what have we had for decades and what changes did Trump make, and then we can talk about what kind of impacts they're going to make, okay? So I had suggested that you print out the slides. If you didn't print out the slides, you might want to tuck in some of the key tables and stuff into your notes. By printing those, you'll understand what I mean. Oh, a second, and my clicker's not in. All right, let's start by looking at federal tax revenue. And this is from 2015. It's not all that interesting, so I didn't update it. It's not going to change drastically. But let's see what some of our observations are here when we look at the federal income tax. The first thing, hopefully, you observe is that the federal income tax comprises a large portion of government revenue. So guys, look at federal tax revenue. And you see that the total is $3.18 trillion from different tax sources. And a lot of it comes from income tax. So, of the government tax revenue, so notice that this covers corporate income, excise taxes, our customs duties, like our import taxes. We've got individual income taxes, payroll taxes. If we look at just the individual income tax, does everyone agree this tells us that 47% of all of our government's tax revenue came from individual income taxes, right? Now when I say individual income taxes, guys, what are we talking about? What do we mean by individual income taxes? Who are individuals? Workers, people like you and me, households, right? We're not talking about firms here. So individual income taxes, we're talking about you and me. We have a job, we do our tax return, we submit our tax return, we pay income taxes. If we look at payroll taxes, that's also a form of income tax, right? Because your payroll taxes, if you're a firm, are going to be based on the income of your workers. So this is also a form of income tax. Payroll tax, we see, if we look at the orange segment, 33% of all government tax revenues came from payroll taxes. And then corporate income taxes, 11%. 11%. Now, I think it was Tyler, it might have been you talking about concern about corporate income taxes being a little low. And if you look at this, if we look at just the corporate income taxes, they might be a little low. And what do we know has happened more recently? Have corporate taxes gone up or down? Down. Yeah, down. But we also need to be fair and remember that when we think about payroll taxes, that is also a business tax too. So we've got to look at it a little more carefully. We can't look at just what is corporate income tax because there's payroll taxes too, and that is an expense that goes to the firm as well. Yeah.
Well, listen, don't all corporations pay payroll taxes?
Yeah. So again, you can argue payroll taxes, are they shared in some sense? Is part of it pushed onto the worker? Does the worker ultimately kind of assume some of that payroll tax in a sense? And again, we're not going to get into that right now. We're going to be talking about tax equity and tax efficiency later. But this 11% is a little bit misleading is what I'm suggesting, that we can't say, oh, firms only pay 11%. I'm married to a CPA. He doesn't only pay 11% in corporate taxes. He's got payroll taxes too. Notice that if we look at what comes from tariffs and excise taxes, we're talking about pretty small amounts. Excise taxes, 3%. So excise taxes are going to be the things like taxes on, cigarettes, alcohol, that kind of stuff, where we're putting per unit taxes in place. So if you don't know what an excise tax is, we've been using excise taxes, right? When we put taxes to solve externality problems, that was an excise tax, right? And then we've got our customs duty. So this might be our import tariffs. Look how small that is, right? Only 1% of tax revenue comes from import tariffs. So guys, if I had a question, true or false, the government, our federal government, uses import tariffs to generate a lot of revenue as a proportion of its total government budget. Would that be a true statement or a false statement?
False.
Yeah, false. So we have reasons for imposing import tariffs, but this is not the bread and butter of our government's budget. Do you see that? All right. Now, we're going to talk about these federal income taxes, and it is a little confusing. While we're going to cover some of the accounting of it, it's also important that you understand kind of the economics of how it works, because then you'll understand tax incidence, you'll be able to talk about tax equity, tax efficiency much better. So let's kind of go through the logistics of how it works, and then we're going to talk about the structure so that you understand the economics behind the tax system. The first step, and I am going to keep it very simple, guys, we're not trying to create CPAs out of you guys. Step number one is that you have to calculate your taxable income. You have to calculate your taxable income. So what that hopefully suggests to you is that your taxable income isn't necessarily equal to your income, right? They're not the same. Your taxable income might be different for everyone. Generally, it's different than your overall income. So the first thing we have to do is calculate our taxable income. We don't pay tax on 100% of our income. A lot of people don't appreciate that. They don't understand that. So there are portions of your income that you don't pay tax on. So we're going to talk about what does that look like and what does it mean. The second thing is that tax rates are what we call marginal. We have marginal tax brackets. We have marginal tax brackets. All right? We have marginal tax brackets. And what that means is, and I'll be illustrating this for you clearly, that you're going to have income that falls into different brackets with different tax rates. In other words, there's not just one tax rate that applies to you. You're going to have income that falls into this tax rate, and then you're going to have income that falls into the next tax rate, and income that falls into maybe a third tax rate. Does that make sense? There's not just one tax rate. And when I show this to you both in chart form and graphically, this will make total sense. But people get very confused about this idea. So you're going to have income that's taxed at different rates. Different chunks of your income are taxed at different rates. Then, number 3, there are different schedules. There are different schedules for your taxes that apply based on your particular situation. So there are different schedules that apply based on your particular situation. So there are different schedules that apply based on your particular situation. In other words, are you married? Are you single? Are you a single parent that's eligible for this thing called head of household that we'll talk about momentarily? But there's not just one tax rate, and there's not just one tax table. So you can imagine why this gets incredibly confusing for people, and that in our current system, the average person is really going to be confused by the complexity that we have. Now, I'm going to be very honest. I am not arguing for an easier tax system. I am married to a CPA, and I like having money. My husband makes a lot of money from people who do not understand this system. So the economist in me says, yeah, this is a little complex, and people don't understand it. The wife of a CPA says, well, let's keep taxes as confusing as possible. I want you to not understand it at all. So understand that I am a bit conflicted, so I'm going to be honest. All right. So let's start by talking about taxable income. So remember what we said, you don't pay tax on all of your income, because everyone is entitled to exemptions. And those exemptions are based on the people that they support. So everyone's entitled to exemptions based on people that they support. So you support yourself. You get an exemption for yourself. So I support myself. I get an exemption for myself. And you might support your kids. So So I have 2 kids in college, I'm supporting them, I get an exemption for them. You might be supporting a spouse. You might even be supporting a dependent parent. So if you have a parent with medical problems and they live with you and you're responsible for a significant portion of their support, then you can claim them as an exemption. So guys, are we all going to have the same exemptions? No, it depends on our situation, right? So exemptions translate into money that you're not taxed on. This is going to turn out to be money you're not taxed on. So remember what I said. We have to calculate our taxable income. Our taxable income's not the same as our income, right? And it depends on our situation. All right? This is money that we're not taxed on. Yeah?
If your spouse has a job, are you still considered supporting them?
So if your spouse has a job, you'll kind of see that that's going to put us on a schedule where we're married, and so yes, I'll get to count myself, he'll get to count himself. We're adding our incomes together because we're filing joint. So yeah, it depends on our situation. But sure, if my husband has a job, he gets to count himself because he supports himself, I support myself.
Or do you count him?
No, we don't get to double count. So I don't get to count my husband and him get to count me. I don't get to count me and my husband count me.
But you could count him, he just couldn't count himself?
We can only count ourselves once. We can only count ourselves once. So, all right. So taxable income, guys. For 2017, and I'm going to use last year's tax tables. For 2017, the exemption, her exemption was $4,050. So what that means is you get tax-free $4,050 for each person that you support. So per dependent. So me, myself and I, my kids, my husband gets to count himself. We can't both count the kids. Only one of us can. So a family of 4 is going to have 4 exemptions. So my husband, me, our 2 kids, 4 exemptions. So understand then, guys, when I have 4 exemptions, this reduces our taxable income. Does that make sense to everybody? This is money I'm not taxed on. So let's say that my income is $120. All right, $120,000. So this is my income. Where did I get this number right here? 16,200.
4,050 times 4.
Yeah. So I had 4050 multiplied by 4 exemptions. So that gives me a taxable income of $103,800. Everybody with me? Does that make sense? So am I taxed on all of my income? No. There's a chunk of it that I get tax-free. And everybody gets some chunk tax-free. All right, so let's say Willie has a job. Willie's single. Does he get any exemptions?
If he's supporting himself.
He has no kids. What was that?
If he's supporting himself.
He's supporting himself, so he gets 1. Yeah, so everyone gets an exemption. At least 1, right? All right, so let me erase my words so we can see what I just wrote. So here's my question. Do you save $1,200 in taxes?
It's 16,000.
Do I save $16,200 in taxes? What did I say, 1,600?
Yeah.
Sorry. Gosh, I don't know, I've done that twice. I don't know why I can't all of a sudden not read numbers. Maybe it's in anticipation of our day off tomorrow. Woohoo. 16,200. Do we save 16,200 here?
No.
How come? That's how much I saved in taxable income.
Because like if your tax rate is like 35%, you're getting taxed 35% of your $103.
Okay. You're on the right track. So what am I really saving then? I'm not saving 16,200. I'm saving what?
16,200 times the tax rate.
The taxes I would have paid on that, right? The taxes I would have paid on 16,200. So make sure you're clear. And I don't have a bullet there, but do we save 16,200? No. I saved the tax I would have paid. And so Tyler said, well, if you're at the 30% tax bracket, and then that money would have fallen in the 30% tax bracket, I saved the 30% I would have paid. You with me? So be very clear, make sure you get that the answer here is no. You save the tax you would have paid. On 16,200. So if that had been at the 30% tax rate, if it had been in the 30% tax bracket, I would have saved 30% of 16,200. Everybody with me? All right, good. So finding your taxable income, that's the first step. All right. Now, understand that exemptions don't apply to the very wealthy. So this makes it more complex. Not everybody gets exemptions. I've said everyone gets exemptions, but that's everyone who's not like pretty wealthy. All right? So normal people, let's call them, get exemptions. But we need to see here that exemptions phase out over income. So that needs to be something that means something to you. Phasing out over income, because that's kind of an economics of taxation. That exemptions phase out over income. Okay, let's see what that means. What does it mean when we say that this exemption phases out over income? So, look at the table. For single people, it starts phasing out at 21,000. So, what we're saying is if you're single and you're using the single tax table, the phase out of exemption starts at 261,500. If you have a taxable income, so that's taxable income, if you have a taxable income of $261,500, you get less and less and less exemptions. Does that make sense? You don't get the whole exemption. It starts phasing out. And it phases out over this range right here. All right? So that exemption is going to continuously shrink until that single person has an income of $384,000. Does that make sense? So at $384,000, you don't get any exemptions. Does that make sense? So does everyone understand what I mean when I use the term phasing out over income? Because I'm going to use that term to show you a lot of things. So make sure that you understand the idea of phasing out. All right? So after $384,000 for somebody on the single part of this schedule, they're not going to get any exemptions. All right? Now, we're going to talk about later the Trump administration and what kind of impact those changes have had. But this is what things were like. So I want you to be thinking, we're not quite there, but we're going to be thinking about tax equity. Does everyone agree that equity is a very normative concept, right? It's an idea of fairness. So do you think that we might have these phase outs to create a little fairness? Remember, we've been talking about a couple weeks ago, taxing higher income people more. And I want to point out that there are some misconceptions that we do things, there are things in our tax code that does result in higher income people paying more. And this is a good example. Everyone agree? Because people who get pretty rich aren't going to get the same benefit with these exemptions. All right. So this clearly connects to the equity issue. Make a note of that because we're going to come back to talk about tax equity later. So equity is clearly built in, and here's just one example. Phase outs over income. And that makes sense, right? People who get uber rich don't need these kinds of exemptions. So they're going to end up paying more taxes. All right. In addition to exemptions, everyone gets a deduction. A deduction. So let's talk about deductions. You have your choice. So when you're completing a tax return, you have your choice between taking the standard deduction, and when I say standard deduction, understand we're talking about something that is defined by government. So the standard deduction is something that is on a chart that government tells you how much the standard deduction is, or you can take what's called an itemized deduction. If you take an itemized deduction, certain expenses are eligible, and you get to add those together to determine your deduction. So a deduction is going to be kind of the same kind of thing. It's going to be money you get tax-free. So you get to pick. Are you going to take the standard deduction, or are you going to take the itemized deduction? Here's the deal, guys, and this is important because a lot of people don't understand this. You don't get both. You have to pick one or the other. So how do you decide? How do you decide? If this is money that's going to reduce your taxable income, how would you decide to take the standard or the itemized deduction?
Calculate both of them and then find out. You calculate both of them and then find out which one fits you.
Calculate both of them. I don't have to calculate standard because it's just given to me, but I need to calculate my itemized deduction, and I'm going to take which one? The one that is bigger, right? Bigger. Duh. I'm going to take the one that's bigger. So somebody like Willie, he's got a job. He doesn't have a house. He's, not involved in a whole lot of things. He's not going to probably have enough itemized deductions to make it worthwhile. He's going to take the standard deduction. We'll talk more about what is eligible for the itemized deduction, but you get to pick. So select the one that's better for you, and that's going to reduce your taxable income. So you're going to take whichever is higher. All right, so is everybody with me so far? So far we have two things that reduce our taxable income. What are they? Exemptions and deductions. Of course, exemptions phase out over income. All right? So your standard deduction, again, that's determined by government, right? So standard deduction, that comes from the government. But it's going to depend on your circumstances. And again, this is why taxes get so confusing, because it depends on your circumstances. Are you married? Are you single? Are you a single parent who's giving primary support to a child? Because if so, you get eligible for this thing called head of household, we'll talk about later. But it's not just the same for everybody, and that's why this makes so much, confusion for people. All right. If you have primary support of the child, so let's say Kevin divorces me, but he says, you keep the kids. So I'm divorcing you, Melanie, you keep the kids. Let's say that I'm responsible for the majority of their support. They're in college, I have to pay all these bills. Then I would be head of household. And that's a more advantageous tax situation for me. So does that sound like we're building in equity also, guys? We're building in some equity there? I mean, if you're a single mom, responsible for children, isn't your life a little tougher than somebody with the same income who's not a single mom? So we've created a table especially for that situation that gives them some tax advantages. So we have equity built in a lot of ways. We're going to do a unit on equity, but kind of be thinking, make a little notes to yourself about where we see equity come into play. All right, so here we go. Let's take a look. These are the deductions, all right? So we're looking at these deductions right here. Let's take a look at single versus married filing joint. So you understand what I mean by single. It's just Willie. He's only responsible for himself. He's not married. Versus married filing joint. That's Kevin and me. And we filed just one tax return together, right? I'm not going to file my own tax return. I'm married to a CPA. He's going to file them together for the two of us as if our income's joint. All right. What do you notice there when we look at the deduction for single versus married?
It's the same, just double.
It's the same. It's just doubled, right? So if we take 63.50, multiply it by 2, we get 12,700. So is there any penalty for deductions to be married? Is there any penalty? No, there's no penalty. There used to be a penalty. They used to penalize you. You got a smaller deduction if you were married filing joint. And then they got rid of that. Now, what do you notice about head of household? What about head of household? Let's look right here. Now, head of household, are you married?
No.
Who's head of household, guys?
Single parent.
So we've got a single parent who's responsible for the care of a child, right? The majority of the care of a child. But their deduction is what?
$300 or $3,000.
$3,000 more, right? So they get $3,000 more. Tax equity, right? Because a single parent raising kids compared to somebody else with the same exact income, they're going to have more to deal with, more expenses, right? So we're trying to smooth things out, make it a little bit more fair. All right. Any questions about that? Now let's assume Bob has an income of $120,000. Let's just do some very simple math. Bob has an income of $120,000. He's married. He has 2 kids. And he's going to take the standard deduction. He's going to take the standard deduction. What is Bob's taxable income? Okay. What is Bob's taxable income? So I want everyone calculating it. If you need to get out a calculator, you can. It's pretty easy math.
Did we define what the amount for standard deduction was?
There you go. So you've got the exemption amount in your notes, right? It was, are you asking a question?
Yeah,
Uh-huh.
it relates to the question, how is he filing his taxes?
Let's say he files joint. We're always going to assume married people file joint. It's
Yeah.
advantageous for married people to file joint. So
Then we're missing something.
what are we missing?
His spouse, ECON.
Oh, let's just say he doesn't.
Okay.
She doesn't have one. That's a good question. Yeah, let's just say she doesn't have one. So, everyone have the deduction? Are you asking a question or answering it?
That's a quick. Are we assuming that he's taking a personal exemption?
Standard.
Well, you guys answer that question. Would Bob take a personal exemption?
Yes.
So,
Would you ever say, nah, I don't want that? Right? So, is he taking one?
Yeah.
Yeah, right? Okay. So, Bob has an income of $120,000. He's married. Yeah, I should have had somewhere on here that he doesn't have he has a spouse, but let's say she doesn't have any income. 2 kids. He takes the standard deduction. What's Bob's taxable income? How many of you have it calculated? What does it turn out to be?
I have 93,900.
93,900? Some of you don't.
101, 300.
Okay.
101,000.
So what do you have, Ibrahim?
101,000.
101,300? Okay, and I'm getting people shaking their head on that too. All right. So,
Well, I got it wrong.
so
Oh, I didn't check.
let's take a look. Let's make sure I didn't make a mistake. He has income of 120. He takes, where's this number come from? 6,200. Where's that come from?
It's an exemption, 4 exemptions.
Okay, so he's got 4 exemptions. So Tyler asked, would he take a personal exemption? Yeah, you're always going to take exemptions, right? If not, you're paying more taxes than you'd have to. Where did this number come from? 12,700.
Deduction.
That is his deduction if filing joint, right? And we'll talk later about kind of why that makes sense to file joint. But in a nutshell, guys, what you're going to see is that it's kind of like taking some of his income and transferring it to her, which is going to lower marginal tax rates. So filing joint makes sense. So I get 91,100. Is that what you had, Tyler?
Oh, no, I calculated it wrong.
Okay.
That's all right.
Okay. So everyone see where I got this? All right. Where'd you guys go wrong?
With for the kids.
So how many, did you have the wrong number of exemptions?
Yeah, I put 2.
Because you forgot about
Her spouse and himself.
Bob and Bob's wife, right? You always get one for yourself. All right? So guys, is there a pretty big difference between Bob's income and his taxable income? Yeah. So there's a good chunk of money that Bob gets to earn tax-free. Everyone agree with that? Okay. And we agree that his income's not high enough for these phase-outs, right? Not high enough for these phase-outs. He has to make a whole lot more money before these phase-outs even apply. All right. Now again, Bob has a choice between the standard and itemized deduction, right? And how do you decide which one you take? The one that's higher. So if he chooses to itemize, he can add up all of the possible deductions. And here's where people definitely get confused, because you got to know what's allowed. One thing that's allowed is the interest from your mortgage. The interest from your mortgage. So not your whole mortgage, but the interest you pay. Guys, can this add up to a lot of money? What do you know about mortgage loans? When you pay them, what do you pay first, the principal or the interest? So let's say I have a 30-year loan.
Interest.
You pay the interest first, right? So when you're young, this can be a pretty big tax deduction. Guys, why do you think, from an economic standpoint, that we have interest on your mortgage as a deduction, as an itemized deduction? Why might that make sense? Gracia, why might that make sense? Well, think like an economist. You get to deduct the interest on your mortgage, which might give you a bigger itemized deduction than the standard deduction. What does that do to the cost of your house? What does that do to the cost of home ownership, guys? It lowers it, right? It lowers the cost of home ownership. So understand, guys, that by deducting the interest on your mortgage, since the first years you're paying all interest on your loans, you take out a 30-year note, you're paying all interest at first. So this can be a sizable amount. This could be enough for you to decide to itemize just on the basis of the interest, which means you have a bigger tax deduction, which does what to your taxable income? Lowers my taxable income, which means less taxes, which means more money in my pocket. Does this make it easier or harder to own a house?
Easier.
Easier to own a house. Do you think in the United States we value home ownership? Do you think there's benefits for people to own their own homes? Kind of part of the American dream. And this helps it become a little bit easier, right? Other things, charitable donations. Charitable donations. Now, we're not going to get into all of this, but can I go to an auction, buy a sofa, spend $800 and say, woo, charitable donation, because it was a charitable organization holding the auction? Can I do that? I go to an auction run by the, let's say, Red Cross. I bid on a sofa for $800. I take that sofa home, but I've just written an $800 check to the Red Cross. Do I get to write that off? No. Because?
Well, you bought it.
I bought a sofa. Basically bought a sofa. I got the sofa. So I don't get to write that off. But what kinds of things might I get to write off? Tyler?
Well, I know my parents did this a couple years ago, was they donated an old car.
Sometimes you can donate things that are possessions, like a car, and then they can sell the scrap metal, and some organization gets money, so you can write that off as a charitable donation. What else?
Clothes to Goodwill.
If you give clothes to Goodwill, they'll give you a receipt that you can use. And then, of course, if you give money, if you donate to an organization that is an approved charity, you get to write that off as a charitable donation too. Yeah.
Does like church tithing count?
You know, that is a good question. Does tithing to your church count? I don't know. That will be a Kevin Sheehan question. I'll get you an answer to that.
It matters if they're registered as a nonprofit.
Well, it does matter if they're registered as a 501c3. But what I don't know is if churches get to be 501c3 status. If they are, then yes. But if no, then they're not. But so the real question I have to ask Kevin is, can churches register as 501c3s? So I'll ask him that. Personal property taxes. What do you pay personal property taxes on?
Luxury taxes.
Okay, luxury taxes like on my boat. What else? House, car. So personal property taxes. So bottom line, guys, and there's more things. I'm not going to list them all. You'll read a little bit about this. But I'm adding up the things that could qualify. So I'm adding up these kinds of things plus other things that qualify. And I'm determining the size of my itemized deduction. And if it's bigger than my standard deduction that I'm entitled to, then I should itemize. The last note says usually you'll itemize if you have a mortgage. So if you have a mortgage, it's probably going to push you over the threshold so that itemizing makes more sense. And remember, there's a tax benefit when you own a home. It makes owning that home a little bit cheaper, getting that home a little cheaper. So remember that when you guys get into the working world and you're trying to figure out, can I afford this house? Well, it's going to lower your taxes a little bit. All right. So we've just talked about this. Effectively, the fact that you can itemize and deduct your interest on your mortgage lowers the price of your house by a little bit because of the tax benefit. But you guys already understand that. All right. Now, does everyone understand this? We all understand that deductions and exemptions lower our taxable income. Everyone agree with that? So, let's ask the same question we've already asked. If you have $29,000 in an exemption and deductions, are you literally saving $29,000 in taxes? What's the answer?
No.
No. What are you saving?
The percentage you would have paid.
The tax you would have paid. So be very clear. This amount that you get tax-free doesn't literally save you $29,000 in taxes. It saves you the tax you would have paid on $29,000. That makes sense to everybody? So if I'm paying, 25% for that money, it saves me 25%. It's still sizable though, am I right? It could be many thousands of dollars. All right. So here's another question. Do all families with $29,000 in deductions and exemptions benefit at the same level? Do they benefit at the same level? So let's say everyone in here is a family. We all have $29,000 in exemptions and deductions. Are we all saving the same amount in taxes?
No.
The answer is no. What does it depend on?
The tax bracket.
It depends on what tax rate we would pay, right? Do we all pay the same tax rates? No. So it depends on the tax rate that income would have been subjected to. So what I'm saying is that mine might be 31%, just making up numbers, and maybe yours is 20%. These probably aren't actually real marginal tax brackets, but you understand what I mean. So do we all benefit the same? Who benefits more? Who benefits more from the exemptions and the deductions?
You
Me. Why?
save a higher percentage.
Because I'm saving 31% on the money, you're saving 20% on the money. You with me? So the higher tax bracket that you're in, the better off you are from these exemptions and deductions. So now we're kind of back to Tyler's point. Well, maybe high income people aren't paying their fair share, but at some point, what do we do to try to make it a little more fair? Phase it out, right? Phase out exemptions. Does that make sense? You guys with me? All right. So not all families have the same tax rates, so we don't all benefit the same from exemptions and deductions. Are you kind of getting a sense of the complexity here and how there are equity issues built in? And sometimes things become more equitable and some things might become a little less equitable, and then we have to offset them with things like phase outs. That's why this is incredibly complex. That's why my husband makes a good living, folks. And as I said, not gonna lie, I want it to stay nice and confusing, but the economist in me knows this is just too much for people to get their brain around. All right, let's move on to talk about marginal tax brackets, because this is another incredibly complex thing. The United States does not have a flat tax. The United States does not have a flat tax. We're going to talk more about flat taxes later. What do I mean by flat taxes? It would be one tax rate. So there is not just one tax rate. That would be a flat tax, and we do not have that. So if everyone paid 18%, that would be a flat tax. I don't think I have it. So flat tax would be that we all pay 18%. That's a flat tax. All right? We don't have that. Instead, we have multiple tax rates. We have multiple tax rates. But they're marginal tax brackets. And that's incredibly confusing. So let's make sure we understand what I mean when I say we have marginal tax rates. So they only apply to the income that falls in each bracket. So that means you're going to have income taxed at one rate, more income taxed at a second rate. You might have income that's taxed at a third rate, some income taxed at a fourth rate. And when I show you the chart, this will be clear. But they only apply to the income that falls into each bracket. All right? Now, the set of tax rates are the same for each person. Everyone has the same sets of tax rates. The tax rates don't change for you versus me. So Willie is single. I'm married, filing joint. We do not have different tax rates. Here are the tax rates for 2017. The lowest bracket is 10%. So you might have some income that falls into 10%. So let's say I have some income that falls into 10%, but then I have income that spills over to the 15% bracket. So some of my income's at 10%, another chunk is at 15%, a third chunk is being taxed at 25%. If I have high income, some of my income is going to be taxed at 28%. If I have really high income, some at 33%, then some at 35%, 39.6% is our highest bracket. But there's not just one tax rate that applies to you, because they're marginal. Some falls into this, some falls into that, some falls into the next bracket, all right? So our highest bracket, oh, I've just repeated myself, 39.6%. You guys get that. But how many dollars, and this is what's confusing, how many dollars falls into each bracket depends on your status. Remember that status? Married, single, head of household. Single, married, head of household. That determines the size of the income range in the bracket. But Willie and I have the same brackets, 10, 15, 25%, 28, blah, blah, blah. The amount of income that falls into each bracket depends on which table we use. Are we single, are we married, are we head of household? So let's look at just at the single bracket. So this would be Willie. Now, Willie's going to pay 10% tax for any money. So he's going to pay 10% for any money that falls between 0 and 93.25. So what that means is 93.25 of Willie's taxable income, make a note here, taxable income, we've already calculated that, not all income, but just our taxable income, 10% tax rate for the first 93.25. But let's say he makes more than that. Now he gets bumped up to 15. But only the money that falls between 93.25 and 37.950. You with me? Now let's say he makes more than that. So he's got income that spills over to the 25% tax bracket, which starts at 37.950 and goes to 91,900. Everyone agree that 25% tax bracket is very large, right? Everyone agree with that? All right. So if we created a graph, folks, and we'll finish here in just a minute, if we created a graph, whoops, I don't have it, I have it later, what would it look like? What would it look like, guys? Do you agree that it would be a kind of a stair-stepping like thing? But of course, the size would adjust based on how many dollars. Do you see how confusing this would be for people? Yeah. So when you go on TurboTax and it asks you all these questions, it doesn't allow you to understand how your taxes were calculated. It simply says, are you married? Yes or no? How many kids do you have? If you're single, do you have kids, and how much portion of their expenses are you responsible for? And it starts calculating your taxable incomes and your exemptions and your deductions. And then it says, do you own a house? How much property taxes did you pay? And now it's calculating your deduction and deciding should you take the standard. And then it's going to come back with, here's your taxes that you owed, and that was based on this table right here. All right, we will pick up here next class period. Please read announcements so that you know what your homework is.